in today's world, 2021, there are so many ETFs, pretty much more than individual stocks. So, and the thing is, because you have so many ETFs right now in investing world, they get confusion. A lot of people always ask, this is in a comment, either they ask me directly or from what I can see comments on other channels or on the radio station. It's always about which ETF is better. Should I invest in this ETF or should I invest in this ETF? So I'm here today to make it easy for you to be able to know the difference between this ETF and this ETF, and which one will suit you, which one will be better for you to invest your money in this 2021. So bear with me here. I'll go really quick, and if it's your first time, this is Money Mind channel. We talk about personal finance and investing on this channel. So if it's your first time, please subscribe, hit the like button. So here I'm on Morningstar website, and you can see so we compare between the S&P SPDR S&P 500 ETF Trust SPY and Invesco Trust. So we'll go through the overview, performance, and holding and sectors these ETFs invest in. So we'll go with inception date. So inception is when the fund was started, like the first day when it came to the market, when it's structured was we can see SPY has been the oldest one. It's been January 22, 1993. And then Invesco was incepted in March 10th, 1999, just before the .com bubble. Morningstar category, right? It's a large blend. So this is a large blend, which I mean is large stock, which is a blend, different sectors. When we come to the Q, we'll see is a large growth. That's the difference. So you have a large blend, which is different sectors, different industries. They all blend together, but they're large companies, not small. When you come to here, we have the large company, but they're more of a growth company. It's more of a tech heavy companies, as we'll see in the 10 top assets. So assets these funds have, this one has about 340 billion. SPY, which has most, because it's been longer, of course, has a lot of more money. It's like a 300, and half of that, it's 150 billion. That's a QQQ. MER, management expense ratio, so how much you paying for you to have this fund, which is annually. This one you would pay only 0.09, and this one you pay 0.20. So this QQQ is more expensive, and it's because it's a growth, right? So you're expected to pay that for that growth, which this one is more yes, it's a growth, but at the same time it's gonna blend growth and value at the same time. Prospectus benchmark, so this one of course is benchmark of it is S&P 500 Trust USD. This one follows the NASDAQ 100. Equity style large core, this is large growth, as we said. So now we'll go into performance. So we can go to another website here, and we'll see performance of this fund, and we'll go back to the chart. So 1 week return, you can see in just 1 week, this is a Q and this is a SPY on this side. So we'll see this is a 220, this is 27. So let's go to a year to date, right? 2021. The SPY right now has about 5% return. This is more volatile. You can see it's half a percentage. It went all the way up to 10%, and then recently just came back again to have 1 year return. So you have 1 year performance of 79%, almost 80%, versus 61 on SPY. So I mean you have more money growth on this one. PE ratio though, the value price per earning ratio, overall when you on aggregate, when you combine all the stocks together, you have 35. This is 25. So this is QQQ is very expensive right now, because most takes like a Tesla company, they all take big chunk of QQQ, and they're very expensive. Tesla itself has about 170 PE ratio. You know, here you have company like Walmart, you have like Johnson & Johnson, they only have a PE ratio of like 20. Dividend here, because it's a growth, it doesn't pay much dividend. So dividend up to is only 56 cents. So this one year to date is 158, and the yield 145, and here is only 0.55. So it's very little in terms of dividend. Annual dividend yield, that's how much you see right there. Okay, when we come to volatility, this is 54, so way crazy here. QQQ. When we can see SPY, I forgot about 5 days. Go to 200 days of volatility. So this is 23%, this is 16. So the higher the number, of course, the more volatile is compared to the market. You know how much up and down it goes, right? So that's volatility. Let's go to that's performance in terms of the number. So let's go to see the chart itself. We go to max here. We'll see, according to this chart, in 2009 they all, even though this so right now, even though the SPY was incepted in 2003, but we start, because we compare the two, so we're gonna start in 1999. If we come to this chart, we'll see here .com bubble. You see the Q, that's a blue one. You see how much volatile when it went all the way up, it was so high, and then it fall really bad. And then from then the gray, which is the SPY, was leading. It was just always kind of more sturdy. It was outperforming from 2000 up to 2006. 2007 the market crash again. From there on, you can see they kind of went all the way almost in parallel. And from 2015, right, that was from 2015, the NASDAQ or QQQ took off, was outperforming the SPY, you know, S&P 500. And you can see how much it went from 2015 to 2021. It's way, you know, it's just outperforming like crazy. It's way too much, right? But with that performance, you can see the volatility is even higher though. So if you can stand, then it's a good fund for you. You can make more money with that than this one. Trading performance, you can see we've gone already through that one. You know, 3-year annual return, it's about 14% on SPY. Q, you'd get 24. 5 years, 16 on SPY, is 26 on QQQ. When you come to 10-year period, QQQ, you have a 19%, where you have SPY only 13%. Since inception, since the fund was started in 2000, you know, between the two combined together, SPY has outperformed the NASDAQ QQQ. Because you remember in 2008 this crash more, and in 2000, so that's why this one get an edge for that, you know. But within these 5 years or 10 years period, we've seen the Q has just smashed S&P 500. So portfolio, the US stock, you can see this is a portfolio allocation. US stock is 98% on SPY is a US companies. Q has about 98. Non-US stock, SPY has only 0.91, less than 1%. This one has about 4%, is international stocks, you know, because it has a tech company like Alibaba, like JD.com. Those are Chinese companies, so of course it would have those 4%. Some very little in Europe and China. Now we come to sectors. Now we have consumer discretionary. This is about 18% Q, and this is only 12%. So we can see here, if we go really quick, we can see information technology. The Q, because they say most people call it as a tech heavy index. Of course, it has almost 50% of its index of its holding, it's all on tech stocks, you know, technology. But it does have some other little bit. You can see communication service, which pretty much communication is almost linked to kind of technology, you know. But you know, because now, for example, Apple, it's, you know, part of that kind of communication. There's AT&T, but we can see mainly is technology and communication service. Consumer staples, right? It's about 4%, and consumer discretionary is about 18%. You have to understand, company like Starbucks, company like Apple would also be part of consumer discretionary. When it comes to financial, right, those are your big banks like JP Morgan Chase, you know, Bank of America. Of course, it doesn't have any. When it comes to industrial, company like a Boeing, you know, of course, very little. Material, of course, zero. Real estate, zero on Q. But on SPY, you'd have some of material. Communication, of course, you'd have more on this side than this side. Utility, it doesn't have utility, pretty much is zero. Equity exposure per region, like different countries, right? North America is about 99% on SPY, and Q is about 96%, because that 4% is international, as we said, right? Then we can see who takes a big chunk international. Is Asia, take about 2%. Asia emerging was 2%. That will be China and Korea. We compare the risk between the two. Let's just go to better, you know. Better, so it's compared to S&P 500, or the market itself. We would have 1.4%, and this is 1. So this is, of course, it's the market itself, S&P 500, right? So this is a benchmark. So benchmark would see is exactly 1. You know, that's a two-year risk, versus this one is 1.04. So the higher the number, the more volatile. You know, that's how it is about risk. Risk is more of beta, is more of you know, how much your stock or your fund is more volatile than the market itself, which is the S&P 500 at this point we're talking about. So this is a little bit more volatile, and we saw the chart there earlier, right? Let's go to holdings now. We can see, because we didn't talk about holdings, we need to see about what top holdings of these between these two. We've talked about sectors, right? Now we see the biggest on this side, though. Now we have, this is SPY on this side, and this is a Q, you know, on this website, which is etfdb.com. We can see the holding. The biggest holding here on the Q is Apple, where the S&P 500 is only 5%. So you can see the percentage of the first 10 companies. They're very little. Look at the percentage of the top 10 on this one. They're very heavy. 10%. Microsoft takes about 9%. Amazon is about 8%. Tesla is about 4%. Tesla here is all the way down there. It's only 1.3%. And the 10th one here is Johnson & Johnson, while its 10 here is Intel. It took about 2.12%. So those are the top 10. And if you want to go more, I can put the link of this website. You can go see all the holding of all the companies. But we can see the top 10 here is Apple, Microsoft, Amazon, Tesla, Alphabet, Facebook, Alphabet, Class A, Nvidia, PayPal, Intel. Amazon took about 8.5%. Here's only 3%. So that's a comparison between the two. So which fund should we invest in? If we go here, we can see, let's say analyst text, what analyst says about this fund. So this is between the two. Here I can tell you in little details that both QQQ and SPY, they're one of the heaviest traded ETF, you know, on the market right now. So they are heavily traded, and most people use Q as trading vehicle. Same as SPY, you can see the volume. It has high volume. So if you can if you can put up with volatility, I think Q will give you the more return, because for the growth that for this pace of growth that is going, it seems that it's doing really well. But at the same time, SPY, S&P 500 is more broader, has more broader investing. It holds more stocks, about 500, right? Versus this one, QQQ, only hold 100 stocks. So, you know, you wouldn't go wrong with either of them. But one of the things I would suggest is what I've seen a lot of people do would take this and do invest in this. But pretty much all the stocks that are in here, they're already in here. But not all the stocks that are in here, and not all the stocks that are in here on SPY, they would be in Q. So, I mean, if you just want to invest in one fund, you may as well just SPY, or you can just invest in QQQ and, you know, hold your position for a long time. I think you'll do fine with both. You know, that's my conclusion. You know, so if you have any question about these two funds, just make sure you you know, you leave your comment, you know, or if you have any suggestion of any fund that you think is better. And I put more link on the other comparison I made in the past, QQQ versus VOO. I've made comparison between VOO and VTI, you know. So, you know, there you have it. You know, thank you very much for watching. Till we meet again.